Let's get straight to it. The investment landscape we're all operating in requires a blunt assessment. The familiar guideposts that we've used for a generation, they're gone. We're on a new frontier.
And let's be clear, that isn't some cyclical observation. It's a statement of finality. The entire economic architecture of the last 30 years, the one optimized for the lowest possible cost, anchored by disinflation, and built on the idea of geopolitical stability, that's been completely dismantled. What's replacing it is something fundamentally different.
So our agenda today is really a framework for how to navigate this new world. We're going to start by defining the landscape, and then we'll dissect the three structural forces that are now driving market outcomes: the AI investment paradox, the hard reality of a fractured world, and the persistent structural shift in inflation. From there, we'll get into the critical portfolio implications.
Right. The central challenge for any portfolio today is navigating the collision of these forces. You've got the immense promise of AI-driven productivity on one side, but on the other, you have these acute pressures from volatile inflation and a total reordering of global power, which now puts resilience way ahead of simple efficiency.
And you can't look at these as independent variables. They're all interconnected. For instance, the huge demand for AI compute power just makes energy constraints worse, which of course fuels inflation. And this drive for supply chain resilience, well, that is by its very nature inflationary. These are shifts you just can't avoid.
So let's tackle the AI supercycle first. The market narrative, as we all know, is one of just unbridled optimism. But the reality is far more complex. We have to start questioning the disconnect between the staggering amount of capital being deployed and the actual timeline for tangible, broad-based revenue.
The sheer scale of the capital commitment here is, well, it's staggering. We're projecting that major U.S. tech firms are going to triple their annual capital expenditures from about $150 billion in 2023 to over $500 billion by 2026. Just to put that into perspective for you, this spending now makes up nearly a quarter of the total capex for the entire U.S. market.
And if you look at the structure of this investment, it reveals what we call a classic capital expenditure hump. All the spending is front-loaded, and it's immense, while the returns, they remain back-loaded and, frankly, very uncertain. History is just littered with these paradigm shifts where the companies that built the infrastructure didn't end up being the ones who captured the value. So this poses the central question for anyone managing risk. Given a scale of capital we're talking about, figuring out when we cross the line from rational exuberance to an irrational bubble is absolutely paramount. We have a very clinical framework for making that assessment.
Let's just apply this 5-point checklist to what's happening in AI right now. First, the paradigm shift. Okay, it's real. But unlike the dot-com era, we're not seeing excess capacity yet. In fact, data center vacancy rates are at record lows. Second, credit. Availability is definitely increasing. Look at Oracle's recent debt issuance. It was 5 times oversubscribed. That's a key watch point. Third, leverage. We're seeing financial engineering accelerate. Things like debt collateralized by GPUs and these circular investments inside the supply chain. Fourth, valuation. The gap isn't alarming in public markets yet, but in private markets, AI startups are commanding valuation premiums of over 200%. And finally, fifth, speculation. Participation is building for sure, but it's still concentrated. So the conclusion is this: the ingredients for a bubble are present, and they're mixing, but a full-blown systemic bubble is not here yet. The risk is forming, not peaking.
And you have to remember that risk in the AI space doesn't exist in a vacuum. It gets amplified by the second structural force we talked about, the permanent reconfiguration of the global order. The era of just optimizing supply chains for cost, that's over. The new imperative is resilience and security of supply. And this isn't some temporary trade dispute, it's a complete regime change.
The data on U.S.-China decoupling is unambiguous. This chart right here shows the share of U.S. imports that come from China. It's falling from 22% back in 2017 to just 12% today. That represents a tectonic shift in the world's most important trade relationship, and it's really Exhibit A of this global fracture. The consequence, then, is the consolidation of regional trading blocs. As this chart of projected 2025 tariff rates shows, the differential clearly favors North America over China. The rise of Mexico as a manufacturing hub, the strengthening of the whole USMCA corridor, these are direct outcomes of that strategic pivot away from China.
It's a fundamental trade-off. The world is consciously choosing resilience over efficiency. And what that means is we're moving from a focus on the lowest cost to a focus on security of supply. The direct result of that choice is a structurally higher floor for inflation and the introduction of new, potent geopolitical risks into the capital markets.
And that shift towards resilience is, as we've said, inherently inflationary. That brings us to our third structural force, and it's perhaps the most underappreciated threat of all, a permanent shift to a higher, more volatile inflation regime. For many portfolios, the most significant risk isn't some sudden market shock, but the slow, irrevocable erosion of real wealth.
A key driver here is persistent fiscal activism. This chart displays the 2024 budget deficit as a percentage of GDP for key G7 nations. If you look closely, with the exception of Japan, every single government is running a wider deficit today than they were before the pandemic. This reliance on fiscal stimulus creates a constant tailwind for aggregate demand, and that's what keeps inflation sticky.
So the crucial takeaway here is that the entire baseline has shifted. We believe 3% is the new 2%. And that's not just a forecast, it's an assessment of structural drivers. You've got changes in corporate and consumer psychology, the rewiring of supply chains, capacity constraints in housing and power, and these persistent fiscal deficits. They've all combined to raise the floor for inflation.
As a consequence, markets are starting to differentiate sovereign risk much more acutely. We can actually measure this using a metric we call fiscal stress days. We track the percentage of trading days when a country's stocks, bonds, and its currency all fall at the same time. And notice the United Kingdom. This happens on over 10% of their trading days, a level that's more like an emerging market like Brazil than its G7 peers. Now, the US remains insulated for now, but the trend of rising sovereign debt risk is global.
And herein lies the core warning. In a world of structurally higher inflation, holding excess cash is not a risk-free position. It is a position of guaranteed, real terms loss. The primary objective has to shift from just nominal preservation to the preservation of actual purchasing power.
Exactly. This structural shift in inflation directly challenges traditional portfolio construction, especially the 60/40 model. I mean, the 2022 market gave us all a painful lesson. In a typical recession, bonds rally because rates get cut, and that hedges your equity losses. But when an inflation shock is the dominant driver, central banks have to raise rates, which causes both equities and bonds to fall in unison. That negative correlation that investors have depended on for decades, it just vanishes. So given these three colliding forces, AI, fragmentation, and inflation, the playbook from the last decade is for all intents and purposes obsolete. You need a new approach, one that actively manages exposures to these structural changes and acknowledges that the potential for idiosyncratic risk is much, much higher.
Let's be specific about what that means. For AI, you focus on the large cap leaders and the critical supply chain enablers, while actively managing the very real risk of obsolescence for legacy software firms. For fragmentation, capital should prioritize assets that benefit from onshoring and nearshoring, so think North American infrastructure, industrials, and logistics. To hedge inflation, portfolios have to look beyond nominal bonds to real assets that can actually pass through rising costs. And finally, in a more volatile world, traditional geopolitical buffers like gold and energy commodities becoming increasingly strategic.
So we'll conclude with a question that every single investor has to address. These forces of AI, fragmentation, and inflation, they are not cyclical headwinds. They represent a new frontier. And you have to critically assess whether your portfolio is positioned to navigate the pressures of this new era, or if it is still optimized for a world that simply no longer exists.